Picture two friends, both earn £45,000 a year. Both decide, on the very same day, to start saving £200 a month for retirement. Same income, same discipline, same investment fund, growing at the same rate, year after year. 30 years later, one of them retires with £200,000 more than the other. Not because they worked harder, not because they picked better stocks. The entire difference comes down to one decision they made on day one. A decision about which wrapper to put their money into. One chose an ISA, the other chose a SIPP. Today, we're breaking down exactly why that single choice creates such a massive gap, and which one is actually right for you in 2026. Let's start with the ISA, the individual savings account. Think of this as your liquid shield. Every tax year, you can put up to £20,000 into one, and from that point on, every penny of growth, every dividend, every gain, completely tax-free, forever. But here's the catch. The money you put into an ISA is post-tax money. You've already paid income tax on it before it ever touches your account. Think of it like paying a toll at the start of a bridge. You pay your fee right at the entrance, and then the rest of the journey, however long it is, however far you travel, is completely free. No more tolls. No checkpoints. No taxman waiting for you at the other end. That's the ISA's superpower. Simplicity and total freedom on the way out. Now let's talk about the SIPP, the self-invested personal pension. And this is where things get genuinely exciting, because the SIPP works in the exact opposite direction. With a SIPP, you get tax relief at source. Here's the mechanism. For every £80 you contribute, the government, through HMRC, automatically tops it up with an extra £20. That £80 instantly becomes £100 in your pension. That's not a maybe. That's not a if your investments do well bonus. That is an instant 25% return on your money the moment it lands in your account, before it's even been invested in anything. Now stretch that across 30 years of compounding. That extra £20 for every 80 you put in isn't just sitting there. It's growing, year after year, alongside your own contributions. Over 3 decades, that government top-up alone can become a genuinely enormous chunk of your final pot. Here's where the story shifts. Everything we've discussed so far applies whether you're a basic rate or higher rate taxpayer. But if you earn over £50,270, the point where you cross into the higher rate band, the SIPP stops being just an investment. It becomes what we call a tax deletion tool. Here's why. Income above that threshold is taxed at 40%. But if you contribute to your SIPP, especially through salary sacrifice, that income never gets taxed at 40% in the first place. It's diverted, at source, straight into your pension. So instead of the government taking £40 out of every £100 you earn above that threshold, that £40 simply doesn't get taken. It goes into your pension instead, where it then also benefits from tax relief on top. For higher earners, this is the single most powerful, most underused tool in the entire UK tax system. And most people earning over £50,270 are leaving it completely on the table. So why doesn't everyone just pile everything into a SIPP? Because of one word: access. A SIPP is locked. As of 2026, you cannot touch that money until you're 57, with that age set to rise further in line with state pension age changes down the line. If your boiler breaks, if you lose your job, if life throws an emergency at you at age 40, that money simply isn't there for you. The ISA, by contrast, is your emergency exit. Need the money tomorrow, withdraw it tomorrow. No penalties, no age restrictions, no questions asked. This is what makes the ISA essential for anyone who doesn't already have a solid emergency fund sitting in cash. Now here's a number that genuinely surprises people. When you do finally access your SIPP, 25% of the entire pot comes out completely tax-free. Not taxed at a reduced rate, tax-free. Let's do the maths on a pension pot worth £1 million. 25% of £1 million is £250,000, landing in your bank account, completely untouched by HMRC. Compare that to an ISA of the same size. The ISA is already entirely tax-free, sure, but remember, every pound that went into it was taxed on the way in. With the SIPP, you got tax relief going in, tax-free growth all the way through, and then a quarter of it comes out tax-free at the end too. The compounding advantage, even after accounting for tax on the remaining 75%, is staggering. Here's why this matters more right now than it ever has before. The income tax thresholds, that £12,570 personal allowance, and that £50,270 higher rate threshold have been frozen for years, with freezes extending through the current Parliament. But wages keep rising with inflation, so every year, more and more people get quietly dragged across that higher rate threshold without ever getting a real pay rise. This is fiscal drag, and it means that every single year, more of the population becomes eligible for that 40% tax deletion benefit from their SIPP, often without even realizing it. If you got a pay rise this year, there's a real chance you're now exactly the person this strategy is built for. So which one should you choose? Almost always the honest answer is both, but in a specific order. We call this the Waterfall Method. Step 1. Build an emergency fund in cash, typically 3 to 6 months of expenses. Step 2. If your employer offers pension matching, contribute enough to your SIPP to get the full match. That's free money. Never leave that on the table. Step 3. Fill your ISA up to that £20,000 annual limit. For flexibility and tax-free growth you can access anytime. Step 4. If you're a higher rate taxpayer and you still have money left to invest, push additional contributions into your SIPP to claim that 40% tax deletion benefit, particularly on any income above £50,270. This order isn't arbitrary. It's designed to balance immediate flexibility with long-term, government-boosted growth. So let's go back to our two friends. The one who chose poorly didn't just pay more tax. That's the small story. The real story is the opportunity cost, the 30 years of compounding growth on the tax money they never got to keep. Every pound of tax relief you miss isn't just a pound. It's that pound growing, compounding, doubling and doubling again over decades. The cost of the wrong decision isn't written on this year's tax return. It's written on your bank balance 30 years from now, and by then, it's far too late to get it back. Choose your wrapper wisely. Your future self is counting on it. If you learned something from this video, like and don't forget to hit subscribe.